Hi everyone, I'm David Couch and I'm the founder of David Couch Consulting. We help startups and small UK businesses with accountancy and tax advice. Today I'm going to talk about how you, and if relevant your spouse or partner, can pay yourself efficiently if you're a shareholder and director of your own limited company. I'm going to look at salaries and dividends and what the optimal amounts of each of these are to minimize your tax bill. And I'll touch on a couple of other key considerations as well. First off, as a director and shareholder, you have two main ways to extract money from your company, i.e. salaries or dividend. A salary is paid to you just as you would for any other employee, and it's a deductible business expense, which lowers your company's corporation tax bill. Corporation tax is currently 19% for profits under £50,000, rising to 25% for profits above £250,000. But salaries attract income tax. If your annual salary is over the personal allowance of £12,570 per year, you are liable for 20% tax, and also employees' national insurance contributions of 8%. And in addition, your company is liable for employers' national insurance contributions of 15% on salaries over £5,000. On the upside, paying a salary to yourself builds up your national insurance credits for state pension and benefits. Now, unlike salaries, dividends are paid from after-tax profits, so there's no corporation tax relief for them. Dividends are generally good, as there's no national insurance to pay on them and income tax rates are lower. There's no tax to pay on the first £500. This is your dividend allowance. And then for dividends over £500, but less than £50,270, the rate you pay is 8.75%. Above that, the rate increases to 33.75%. And once your dividends are above £125,140, the rate of tax you pay rises to 39.35%. On the downside, dividends don't count towards your pension credits. So what's the optimal mix for tax purposes? Most sole directors should pay themselves a salary of £12,570 each year. That uses your full personal allowance with no income tax or employees' national insurance contributions. Plus, it gives you a qualifying year for your state pension. It also saves your company a bit of corporation tax. You should then take anything else you need as dividends so as to minimize your overall tax liability. So, for example, if your company has £65,000 of profits in a year, then after paying your salary and corporation tax, you could draw approximately £40,000 in dividends, most of which will be taxed at 8.75%. This means that on a total income of £52,570, being your salary and your dividends, you would personally pay about £3,500 of tax. This is an effective rate of tax of about 6.6%, which is way better than if you just took all of your money as salary, albeit your company would have paid 19% on its profits, which is just shy of £10,000. And you would have also had to pay a small amount of employers' national insurance of around £1,000. Now, if your spouse is also a shareholder, they can mirror this. If they work for your company, they can take a salary and also dividends. They would be paid the same salary as you, and then the dividends would be split between the two of you. Paying yourself this way effectively doubles the available allowances and keeps more of your income in the lower tax bands. So this is a very tax-efficient way for couples to pay themselves. Just make sure the shares are properly allocated to avoid challenges from HMRC. Now, some final thoughts on this. Firstly, only take out dividends to the extent that you need the money, especially if you expect profits to fall in the future. Secondly, pension contributions paid by your company into your personal pension fund are tax deductible and grow tax-free within the fund. Thirdly, make sure you reimburse any legitimate business expenses, as these are paid to you tax-free and again are deductible for corporation tax purposes. Fourthly, be careful with directors' loans. If you borrow from the company, this can trigger extra tax if the loans are not repaid. And finally, always declare dividends properly via your self-assessment return. And remember, dividends must be paid from available profits. Your dividends cannot exceed your profits. That's all for today. I hope this has been helpful. If you have any questions or comments, please drop them in the box below or book a consultation on our website. I look forward to seeing you next time.